Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Alright, good evening to all the viewers of Capital Securities and everyone watching online. Good evening everyone. I'm Guo Yuan, a securities analyst at Capital Investment Advisory. Today is Monday, September 8th, marking the start of a wonderful new week. In a moment, we'll be bringing you a detailed discussion on 2 topics, whether it's information, explanations, or in-depth analysis. You should be able to hear me now. We can see that some viewers and online friends have already joined us. Gao Ganghuan, hello, and Ming, and also Alice, good evening, everyone, hello. So first, our first topic is about precious metals, the so-called gold in September and silver October. Which companies are involved, and how can you participate in precious metals? Recently, the precious metals market has been doing really well. It keeps hitting new highs. Actually, earlier, on June 3rd, during the Guoyuan Uni online event, we already talked about this. The title back then was Real Gold and Silver. As the saying goes, real gold and silver defines a certain market trend and its luster. Another kind of luster and market trend. At that time, I talked about the silver Ha principle, mentioned the gold and silver ratio, and also discussed silver mining companies. I remember the stock I mentioned was HL, which I'll touch on again a bit later. So, for today's first topic, let's start with precious metals. Every time you watch the news, especially news from Taiwan, if you hear or see reports saying things like, gold prices are hitting new highs, and there are all these investors or holders of these assets. Whether it's gold bars or jewelry, when these investors take them to sell, it means the market is getting hotter and hotter, and prices are definitely on the rise, because everyone wants to sell at a good price. So if you notice this kind of situation, don't ever doubt that it's mainly about gold, especially gold, because everyone goes to these gold jewelry stores. Even though some places are called silver shops, most of what they deal with is actually gold, or sometimes diamond jewelry. Whenever this kind of situation happens, it means the price has hit a new high again. The long-term bull market has broken through once more. Now, for our second topic, we're talking about the leaders in robot taxis. If you were previously unfamiliar with this area, or if you haven't gotten involved yet and still feel a bit confused or unclear about it, today we can get a better understanding of this market and this field, and also find out which companies are involved. If we haven't participated in its previous rallies or gains, what can we do now? Let's discuss what strategies are available to us. These are some experiences to share, and also some key points to watch in the market that I want to bring to our investor friends. Alright, that was just a little warm-up. Good evening, teacher, and also good evening to Hector and all the viewers watching. Alright, I'm very happy it's Monday, the start of a wonderful new week. Over the next few days, I'll continue to share with everyone updates on the US stock market, the Chinese economy, and the latest news on individual stocks. So, let's get started. First, let's look at the key points. The reason I chose today's topic is actually closely related to last Friday's non-farm payroll numbers. Actually, this topic, the continuation of future trends, will be relevant for quite some time, so no matter when you start, it's never too late. Alright, let's first take a look at last Friday's release of the August non-farm payroll numbers. And the unemployment rate, we can see that previously, the forecast was for a further decrease. That is, the last time it was announced, the number was 73,000, which was already below 100,000. This basically means that the Federal Reserve has started to pay attention to the employment issue. Let's get everyone familiar with this. Let's review. The Fed, which is the Federal Reserve, the Central Bank of the United States, has 2 important missions. These are their main tasks. What's the first one? To maintain long-term price stability. Now, stability doesn't mean prices don't go up at all. Instead, what we often hear about is a long-term inflation target of around 2%. In other words, an inflation rate of about 2% is something they can accept. But as we know, starting from 2020 and 2021 actually, at that time, because interest rates were lowered to almost zero, prices started to stir and began to rise. Even now, they still haven't fully achieved that target. Okay, so the first point is long-term price stability. This is the Fed's first mandate. The second is something like maximum employment, or employment maximization. In other words, on one hand, they consider prices, and on the other hand, they look at the labor market. So, from these 2 points, we can see that the stock market isn't really their concern. Whether the stock market goes up, down, or just fluctuates sideways, actually. For them, it's not really their main job. So everyone, what's most important is that they're focused on these 2 things. Previously, prices were gradually dropping from 7 or 8%, almost hitting double digits, all the way down to 6, 5, or 3. Now that it's at a little over 2 or 3%, right? Actually, they still haven't reached their target, have they? But we're starting to see changes in employment numbers, meaning non-farm jobs. Because in the US, the biggest contributor to GDP and the largest number of jobs are actually in the service sector. Their agriculture and manufacturing probably don't even make up 30% of GDP. There's still a question mark there, but it's almost negligible. You could say about 70 to 80% is from the service sector, so the largest share is services. That's why every time the non-farm payroll numbers are released, it causes huge volatility in the stock, bond, and currency markets. There's a reason for the ups and downs, because this data determines how hot the labor market is right now. And also, it reflects the real situation. This is an indicator released by the government. So last Monday, when the actual number was announced, it was only 22,000. Wow, that's the number of new non-farm jobs, just 22,000. You can imagine what that means. As for the US population, maybe you don't have a clear idea, but it's roughly about 300 million people. With a population of 300 million, the number of new non-farm service jobs is only 22,000. Wow. When this figure came out, you can see. This is way below the expected 75,000. It's not just cut in half, it's not even a third of that. So it's really shocking. But because of this, right? As we just mentioned, the Fed's mission. Secondly, if employment drops significantly, does that mean they might have to shift their focus in that direction? Let's say before, they were always focused on inflation, making sure it doesn't get out of control or flare up again. Next, we'll be watching to see if the Fed starts paying attention to whether employment is about to shrink, or even if we're starting to see a jobs recession. Wow, that's pretty intense. Even though they say they don't care about the stock market isn't their main concern. They do pay attention to the job market, which is directly tied to the real economy. They'll be watching closely. If we really end up with something like the job depression of the 1920s or 1930s, it could affect the entire market atmosphere. If we really enter a Great Recession or a Great Depression, then we're in trouble, because the US simply can't afford to go through something like that at this stage. Now, as for the data, it's pretty much in line with expectations, 4.3, and the actual number is also 4.3. Looking at this trend chart, you can see that 100 here represents 100,000 people. This is in thousands, so 22,000 is 22K, and 100 means 100,000. So, looking at the general trend, if there's a month where the number drops below 100,000, that's still okay for now. It's been 4 consecutive months now, 4 months in a row where the number hasn't reached 100,000. And sometimes the difference is even negative. When it's negative, that's really serious. For example, 22,200 people. Actually, that's not far from being negative. So everyone needs to pay close attention and be really cautious about this. Before this, actually, it was pretty common to have numbers above 200,000. And that's still within this past year. Just in the last year, we've still seen such high levels. That's why people are worried. However, with the growing expectations of a rate cut, some investment institutions or analysts and strategists are even saying, hey, maybe in mid-September, at the FOMC meeting, everyone was already pretty sure, like 80 to 90% certain, that there would be a rate cut, right? Now there are even rumors that a 2-point rate cut might be possible. Of course, whether Powell or the Fed governors will actually do that is still uncertain. But this has already become the main theme for the next week or two. You could say everyone is focused on this. The expectation for rate cuts is heating up even more. But what does heating up mean? It doesn't mean there's a 100% chance of a cut. It's more like the market has already priced it in to this extent. The real discussion now is about how much the Fed will cut, and whether it will be a big cut or a small one. That's the current debate. Besides that, there's also talk about whether there will be a cut in September, then again in October or November, and in total, 3 times before the end of the year. Will they cut every time? Or will they pause once, cut more another time, or maybe just cut by 1 point in one of the meetings? Previously, the forecast was for a certain amount of cuts by the end of the year. So now, is it possible that the number of cuts could increase to 3 or even 4? If there are more, then we'll have to keep watching the economic data to discuss this further, because the Fed pays a lot of attention to economic data. They have a lot of PhDs and researchers who consider all these issues. Alright, next let's take a look at the yield on the 10-year US Treasury bond. This is considered a leading benchmark interest rate. Looking at what happened last Friday, which is represented by this long black candlestick here, you can see that since the beginning of this year, from February to August, the yield has generally struggled to rise above the 4.5 to 4.6 range. Let me draw a few gray lines here, kind of like manhole covers or pot lids, to illustrate this. Right. The message is vivid, everyone gets it. At the start of the year it was 4.6%, and here it didn't even reach 4.6, 4.55859. Every time it goes over 4.6, it immediately faces resistance. 4.5, 4.5, and then here it comes again, and in the past month, same story. 4.3, 4.4, basically, it just can't get back up there anymore. After that, as it started to weaken continuously, there were a few things, whether it was the non-farm payrolls or the ADP report, showing signs of weakness one after another, and the Treasury yield just couldn't go up. Actually, to put it the other way around, since Treasury yields and prices move in opposite directions, that means bond prices are going up. So, whether you look at bond ETFs in the Taiwan stock market or elsewhere, you can see this trend. If you're holding US bonds, whether it's bond ETFs, bond funds, or directly holding corporate bonds or government bonds, it's all the same. Over the past week, or in the last few trading days, they should have been trending upward. But if they're going down, it's because of the non-farm payroll report, which was a big surprise and much worse than expected, less than a third of the forecast. The market is now imagining even more aggressive rate cuts, or that the cuts will come faster, maybe even a double cut at once, or in mid-September, maybe even more cuts right away. By the end of the year, we might see 3 or even more rate cuts, so interest rates could drop off a cliff. In that case, if the next rate cut, which is in mid-September, is only a quarter point, let me tell you, don't be too optimistic. Why? For example, cutting rates too much isn't necessarily a good thing. Why? Back in 2020 during the pandemic, the US went into a national lockdown because of the economy. At that time, if you remember, the Fed slashed rates all at once, dropping by a full point in one go. Everyone thought, wow, they cut by a full point, right? This basically means that even the Federal Reserve was worried that the market and the economy were on the verge of collapsing. If you cut rates too much all at once, that's not good. But if you lower them bit by bit, people feel like you're gradually easing up, and the cost of capital for businesses, the interest rate cost, goes down step by step. Well, whether it's buying a house or using credit cards, for ordinary Americans, they actually like it a lot. Because using credit cards, all of that is pretty normal for them, even mortgages and so on. Of course, most of their mortgages seem to be fixed rate. But for new home buyers, the interest rates, like the 10-year or 30-year Treasury yields, are related to their mortgage rates, meaning for those who haven't bought yet. If you buy, your mortgage rate will basically follow this trend. There's a strong positive correlation. So if it goes up, the mortgage rates for buyers go up. If it goes down, the mortgage rates for new buyers go down. Relatively speaking, that can stimulate their housing market consumption. And this also benefits the consumer credit market, like credit card spending. So this determines a significant cost of capital for the future, and it also serves as a benchmark price for many goods. Let's keep looking. Let's take a look at gold. We already mentioned precious metals at the beginning, so let's start with the big brother. Just like Bitcoin is the big brother of cryptocurrencies, gold is the big brother here. Its trend is negatively correlated. Let me give you an example. This isn't a recent chart, but it's one we can use for illustration. From the beginning to the end of 2022, let's say starting around the end of March, you can see here the yield on the 10-year US Treasury bond. It kept rising all the way up. Whether it was after the outbreak of the Russia-Ukraine war or as inflation started to climb, the yield was also driven up. It quickly rose and peaked around October, hitting a high point for that period. Now, what about the chart below? Let's look at the next chart. This is the price of gold, and it's the same story for jewelry. Around March, prices were relatively high. At that time, it was over $2,050, about $2,050 per ounce. As yields continued to rise, the market was expecting inflation to go up, mainly because the Fed was seen as reacting too slowly at the time. That also drove prices up, because it just kept rising. As we know, with gold, whether it's physical gold bars, gold bricks, or gold coins, or if you're holding gold passbooks from, say, Taiwan Bank, or gold passbooks from various banks, it's all the same. I'm not specifically trying to speak for Taiwan Bank here. Although Taiwan Bank is a benchmark and a lot of people use it, whether it's gold passbooks or if you hold some, well, corresponding gold products, mainly physical gold or gold passbooks. You don't earn any interest from these, right? If we were to put the same amount in a deposit account, say, 3 million, If you put it in the bank, whether it's 3 million or even 10 million, at least you'll get some interest, even if it's just a tiny bit. Usually, it's around 1% to 1.5%, that's the typical rate. If the amount is larger, the rate might be a bit lower. But with gold, there's no such concept of earning interest at all. But if you're investing in gold stocks, there might still be dividends, because if gold mining companies make a profit, they pay out dividends. In the US, for example, it could be once a quarter, every 6 months, or once a year, you'd still get dividends. You can still calculate the yield on those, which depends on your purchase price. But with pure gold, like a gold passbook or physical gold, there's nothing like that, so the interest rate keeps going up. So we think, if we're just regular people holding some money or wealth, and today we want to allocate our assets, we're definitely going to consider this. Say today I have 10 million in cash, and the deposit interest rate has gone up from 2% to 4%. Wow, that means in a year, I'd be getting 400,000 instead of 200,000, right? But if I just keep buying gold? Well, there's nothing, no interest at all. So we can only rely on the price difference, buying low and selling high to make a profit, right? Right, but we really have no idea if, after holding gold for a year, let's say a certain number of ounces, when I sell it a year later, whether I'll make a profit or a loss. That's just uncertain. But if it's a deposit, especially a fixed deposit, it's very clear. For a year, I know exactly what the interest rate will be, and I can calculate it all before I even put the money in. So the direction of interest rates is one of the factors that determines the movement of gold prices. Let's just call this factor X. So if interest rates are rising, like they did in 2022, then the movement of gold prices will be relatively weak. This is actually quite clear. On the other hand, if interest rates are falling, of course, from 2023, 2024, and even this year, there have been ongoing talks about rate cuts. But up to now this year, actually, everyone is still hoping for rate cuts, but there hasn't been a clear and consistent trend of consecutive rate cuts yet. So, let's take a look at this. Gold and silver have been rising together for 2 to 3 years now. So, when did this trend actually start? Here, we're looking at the percentage change, not just the gold and silver prices themselves. The black line represents silver, specifically the spot price of silver, while the gold price is shown in orange or yellow-orange, which is easy to understand. So, when did this percentage change begin? It started on September 8th, 2022. This data is actually from Bloomberg. You can see that it's basically been a steady upward trend, kind of like a gradual climb. We're talking about a slow bull market here, steady and gradual. It fluctuates, but over the medium to long term, half a year, 2 or 3 years, the overall trend is upward. This is very clear, even reaching new highs again in early September. Nokia. When I said goodnight in the group on June 3rd, the price of silver was around $34 or $35 per ounce. But now, it's basically reached $41. I just checked, and it's a little over $41. In US dollars, that's actually quite impressive. I'll show you some other examples in a bit. Okay, let's also take a look at some statistical analysis I've prepared for everyone, like a historical regression. Let's take a look at what happened in the past during an environment of interest rate cuts. So, how does the price of gold typically move? This analysis actually goes pretty far back, like as early as 1989, 1995, 2006, and 2018. As you can see, if we look further back, there were indeed times when gold prices fell as well. For example, first, from the last rate hike to the first rate cut, and then to the last rate cut, this period often includes several rate cuts. This refers to the performance during the period from the very last rate hike to the first rate cut. Alright, next is from the first rate hike, from the last rate hike to the last rate cut. This refers to the period from the first rate cut to the last rate cut, and how gold prices performed during this interval. You can actually see that in the most recent 2 times, or rather, since 2000, in the past 25 years. There have been about 3 times when this kind of situation occurred, and only this one showed a slight drop. The rest, from 1 to 3, all went up. That is, increases of over 20%, 30%, 20%, 30%, 15%, 12%, and even 72%. So now, basically, everyone should have a consensus. Even though we've started to see some rate cuts, it definitely doesn't mean that the big opportunity hasn't reached the final rate cut, right? So at the least, let's assume we're in the second phase and have experienced it. The first time we shifted from raising to cutting rates, aggressive rate hikes happened. UK-style rate hikes happened. In 2022, yields started to rise that year. So, at the earliest, during the first rate cut, We're now between phase 2 and 3, so if we look here, there's still about a 10% or so increase left. Of course, even if we look at 3 out of 5 times, that's still a 60% probability. These are the most recent 5 instances. Alright, let's take another look. In the precious metal sector, which companies are there and how can we get involved? Here, first of all, because last time on June 3rd I talked about silver control, silver prices, and silver mining companies, let's review that again. Last time, we talked about HL, which is Hecla Mining. It's actually a pretty established silver mining company. Whether it's their reserves or their annual production, they're quite significant. Because reserves are a stock concept, while production is a flow concept. Reserves refer to how much is there in total that can be mined, basically, how much of a foundation they have to keep mining. Production, on the other hand, is about how much they can extract each year and sell on the market. Yeah, that's what we call production. So whether it's reserves or production, the silver mining company is among the top. Actually, if I look back at HL, after I talked about it on June 3rd, the price increase was pretty dramatic. If you're interested, you can check it out yourself. But I think basically it's over 30%. From June, it took a break around July and August, but after late August, it started climbing up again. Also, you can take a look at WPN. It's pretty interesting. They use prepaid contract methods to hold shares in many silver mines, so their cash flow is pretty stable and the risk is more diversified. SV is also worth mentioning, silver metals, silicon metals. They have mining areas in both China and Canada, and especially, most of their mining rights are in China. Their other costs are relatively low, and their production efficiency is pretty good. You can keep looking into these companies. No matter which ones, we've provided the stock codes for all of them. If you want, you can watch the replay later or check out the latest news or financial status of these companies. There are just too many companies here, so we can't go through each one individually. But first, I want to introduce this concept to everyone. The trends of gold and other precious metals, like silver, are basically interconnected. There's a linkage between gold and silver. Last time, on June 3rd, we also talked about the gold-silver ratio. The reason we discussed silver back then was because the gold-silver ratio had actually gotten too high, reaching the 90s or even triple digits. So, what does the gold-silver ratio mean? Let me explain it to everyone. It's the price of gold per ounce in US dollars divided by the price of silver per ounce in US dollars. If you divide the gold price by the silver price, you'll get the gold-silver ratio, which is the price ratio between gold and silver. Last time I mentioned it, it was around 98 to a little over 100, if I remember correctly, somewhere in that range. But as I said on the show back then, in the past 2 or 3 years, the more common or central range for this ratio has been about 70 to 80. That's why I especially pointed it out at the time. When we talked about silver, it was in the context of a different trend and market condition, a different kind of trend and market, you know? Next, after we look at silver, let's take a look at gold as well. Basically, you can check out all of these. Take this first one, PAS. It's Pan American Silver, this Pan American mining company. You can also look at AG. Actually, these are all considered established names in the US stock market, and they're pretty well known. For example, they've all been operating for quite a long time. And then, as for gold mining, of course, that's even more of a mainstay. You could say it's a heavyweight in the sector. There are also many companies in this area, so I'll just mention a few of the more common ones. First, there's Newmont, NEM. I think most people have heard of it, and it has a lot of reserves, with very rich resources. It's the largest in the world. You could definitely call it the biggest. We actually mentioned this one before, back in July, during a late-night session when we talked about raw materials stocks, and we brought up AEM at that time. But you could say this stock is quite unique. It operates in Finland, Canada, and Mexico. They have mining operations like this, and then there's Barrick. Barrick also has them. Alright, let's take a look at Freeport-McMoRan. Freeport-McMoRan, the copper and gold company, even though they mainly have copper, they also have gold. Alright, and there's also KGC. Take a look at that too. If you agree with what we've mentioned above, and you think that in the medium to long term, say within 1 or 2 years, with the interest rate cuts coming, as we just mentioned in the statistics. Based on the data analysis and projections, if you still feel optimistic about the future and expect prices to rise, how should you get involved? What strategies should we use? First, when you look at the stock price chart, you need to identify where its support zones are. This is actually a pretty common approach, whether you're looking at moving averages, technical analysis, or even the psychological aspect of market sentiment. It's all about combining these methods for a comprehensive assessment. To find the support zones, you can start by looking at short-term moving averages. First, check the 20-day and 50-day moving averages. These are the most commonly used, whether you're trading Taiwan stocks or US stocks. Now, the second point is, well, when it comes to buying stocks, here's how it works. When buying stocks, we don't need to chase high prices much. Of course, with some strong performing stocks, if you don't chase them, you might feel like you're missing out and it can be frustrating, right? I totally get that. Because we're all investors, I understand how it feels. But still, in the best case scenario, what should you do? If you notice that it has dropped for 2 or 3 days in a row, think about it. Things like gold mines or silver mines, they're just sitting there. The company has so much inventory, and their production is at a certain level. You can basically treat it like a mountain of gold or silver, right? We often say at the market, don't miss out when you pass by a mountain of gold and silver. Don't leave empty-handed after visiting a treasure mountain, right? So just think of it this way. That company owns this gold mine. Or maybe it's a silver mine. It doesn't matter. You can think of it as whatever you want, even oil if you like. Let's just say it's a gold mine. There's only so much gold in it, right? Its value depends on the international gold price, so you can figure out how much it's worth, right? For example, you can multiply reserves or output by the international gold price, and everyone knows the value. So let me ask you, is the value of this thing really that clear and easy to calculate? So today, let's say you want to assume that a company holds this amount of inventory. Let's just say, for example, 5,000 ounces. Just as an example, 5,000 ounces. And let's say the price of gold is fixed at about $3,600 per ounce. You already know it has this much value, right? So would you prefer that this company buys when the price is at $10, or would you rather they buy at $9, or even $8? You already know its value is that much. Of course, you'd want to buy it at $8, right? Because if it returns to the market price, or if the market reevaluates it and brings it back up to $10, $11, or $12, wouldn't you make even more? If you buy at 10 and it goes up to 11, you might only make 10%. But if you buy at 8 and it goes up to 11, then that's 20 or 30%, right? It's really just that simple. If we're talking about companies dealing in raw materials, where both reserves and production are clearly calculated, it's straightforward. But if you're investing in high-tech stocks, that's not necessarily the case, because there are other ways to value them, other methods to assess them. But for companies like this, it's actually pretty clear-cut. Basically, you should buy when the price drops, not when it rises. First, this lowers your chances of getting hurt. If you get stuck in the short term, you have a better chance of breaking even. Second, if the price goes up, your gains will be more significant, and your return rate will increase. Right. That's how it is. There are always opportunities to get in. Don't rush with short-term trades. Now, let's look at trends that last from half a year to a year. This is for holding a portion of your stocks for the medium term. Let's assume, for example, that you have a portfolio with this many stocks. Let's say 10 stocks. Let's use an example, a big pie, or a pizza, cut into 8 slices. This is the pizza. Each slice is 1/8. Suppose your investment portfolio is like a pizza, and among other slices, you have some magnificent 7 stocks. Maybe you like Apple, and next, you want to add that one. Let me also remind everyone about Qiuji's launch event, which will be at 1 a.m. on September 10th, his autumn launch event. Suppose you're optimistic about Google. Whether it's their AI technology or their search engine advertising revenue, you can make that one of the big slices, right? The first slice, the second slice, 1/8, February 8th. If you're interested in some startups, or you think some pharmaceutical companies are pretty good, you can make those a slice too. Then you have defensive stocks, like those related to daily consumer goods. Whether it's Walmart or Costco, you can make that a slice too. So, in my opinion, you can treat this as an idea for your reference. Consider it as part of your swing trading holdings. Because since you already know that the rate-cutting environment isn't over yet, it's not time yet. When they stop cutting rates, or there's talk of raising rates, or if inflation gets out of control again, then things will change. If there's talk of raising rates at 609, or a similar scenario, unless those things actually happen, you can treat this as a swing trade holding. How long you hold is up to you, 3 months, 6 months, the year, it's all fine. If you're satisfied with the return and want to sell to free up funds, that's your call. Or if you see a better opportunity and want to use your funds elsewhere, you can sell. But in my opinion, this isn't meant to be a short-term play, like just 2 weeks. Of course, if you make a return you're happy with in 2 weeks and want to exit and get back in later, that's totally fine as well. So let's just stick to these 3 steps, okay? This opening move, steps 1, 2, and 3, let's follow them. That way, you'll have a better chance, and you won't feel anxious. You'll be more composed. Now, let's take a look and use some real examples to show what we mean by miners, which is the SBN we just talked about. Where are the possible entry opportunities? Actually, I haven't drawn any charts here, right? This is just the line chart itself. We just talked about the moving averages. Where is the short-term moving average? Okay, you can see here, it's already showing you. But actually, if you look at the charts on other phones or on your computer, they'll all look a bit different. Every charting software is a little different, just the colors vary. This purple line here is the 20-day moving average, right? And this shows the daily price movement of the stock. The green line is the 50-day moving average, right? At this point, the best thing to do is, if you're watching it and the price is going up, wait for it to pull back to the 20-day moving average. If you see 2 or 3 black candlesticks around that area, you buy. It's very simple. One more time, what's the key formula? The 20-day moving average, right? If the stock price rises above the 20-day moving average and stays above it, that basically means it's in a short-term uptrend, right? Because it's higher than the 20-day average cost. So when it comes back down to around that moving average, you buy, especially when there are black candlesticks. Let's talk about it. You can also buy on dips. It's better to buy on dips than to chase rising prices. If you follow this, you'll see opportunities. Here's one. Okay, you might get stuck. But if you buy, you might make gains in a few days. If you buy here, after a few days it goes up. If we buy here, oops, we might get stuck for a week or 2, but then it goes up. So what this means is, if you're relatively willing to wait, if you have a bit of patience, and you don't chase after high prices, then that's where the difference comes in, because if you chase, you might end up buying around here. Okay, relatively speaking, it will take longer for you to break even, but you will eventually break even, since we're talking about a trend that lasts from half a year to a year. Maybe you'll still break even, but your buying cost actually determines your future rate of return. Alright, if your buying cost is low, that's a good deal. Your future rate of return will be even more impressive. This is a fundamental principle. So let's assume that's the case. Next, let's look at the second example. Example 2, a gold mining company. Let's use A12, which we talked about in July, as our case study. So where might the possible entry points be? Here, the rhythm and pace are very steady. The tempo is really consistent, almost like a dance, advancing and retreating, advancing and retreating. It goes up more than it goes down, up more than down. You see, like here, it keeps rising continuously. Wow. It might feel like there's no more opportunity. But when the price drops and breaks below here, you buy on the black, not on the red, meaning you buy on the dip. If you buy in at this point, and then combine it with the third thing we just talked about, holding for the swing trade, what do? You just hold all the way until now. Okay, let's say, for example, we didn't get in over there, but instead, after it broke below the 20-day moving average, we entered here. That's fine too. If we enter here, we might be stuck for a week or 2 at first, but then it bottoms out and starts to rebound. If you're holding for the swing trade again, you just keep holding. So right now, you're still holding around here. Back then, the price was about 120, maybe 118, so you could still enjoy a return of around 10% to 20%. So let's go over the example we just discussed one more time. First, observe the support zone and look for a short-term period. Let's say a relatively short one, like the 20-day moving average. Buy on dips, not on rallies. Buy on black candlesticks or when the price is dropping. Don't rush to chase upward trends. Hold the stock for a swing period of 6 months to a year, treating it as part of your investment portfolio. Let's say we cut a pizza into 1/8 slices. Just treat it as 1/8 of the whole and handle it accordingly. Since we're optimistic about the long term, there's really no need to worry too much about short-term fluctuations. Alright, Hector, thank you for your compliment. You want to sell, but you can't bring yourself to do it. If you miss out, you miss out. There will always be more opportunities, as long as you have money. That's right, the stock market is like this. As long as you have money and assets, there will always be more chances. You have plenty of opportunities, so enter the market in batches. The viewer named Fan Hua put it well. The key is to make sure you're picking targets that are on an upward trend. That's right. As for the reasons, we've just reviewed the data and reported it to you. Alright, let's take a look at what's next. This is actually something that, whether we're researchers or analysts, we do regularly, organizing things ourselves. Whether it's a company assignment, or just us observing the market, you can see that this is something everyone notices on a daily basis. NDD refers to the period from September to now, and YDD means from the beginning of the year up to now. The calculated increases are shown here. These are the top 15, actually the top 12. You won't see gold here. If you're looking for gold, you won't find it. Otherwise, you'll just see silver miners. Let's take a look at gold and silver. Okay, gold miners. Let's check out gold mining industry, and silver mining, silver miners, gold and precious metals. These are gold and precious metals. Gold miners, so how much have they gone up since the beginning of this year? This is an ETF, not individual stocks. Even though there are ticker symbols here, it says right here that these are ETFs. So, what is an ETF? It's big. It already holds a lot of different stocks, right? Maybe it holds 40, 50, even 70 or 80 different stocks, and its increase is 100%, and this isn't even an individual stock. So you can imagine how much gold and precious metals have surged this year. Also, always pay attention. What is the X factor for gold and precious metals? The direction of interest rates. Right now, interest rates are trending downward. And what does that mean? Precious metals and gold are moving up. That's just how it is. I just shared some data with you about this. Alright, let's take another look at these market trends. Here we're talking about the S&P Wink with tongue sticking out 100, and I want to point out a few special things about it. First of all, it's endorsed by the stock market legend Warren Buffett. Everyone knows there's only one person in the world called the Oracle of Omaha. Of course, you might hear about Japan's stock god or Europe's, but globally, the one everyone recognizes, and who's still alive, is Buffett. He has publicly recommended it. He actually gave two very famous examples just now. One is, he said, if he were to pass away. Of course, we all hope he'll continue to live a long life. He's truly an asset to the world. While he's still with us, he said that if he were to pass away, aside from keeping some cash and short-term government bonds, he hopes that his family, his wife or whoever, would put the majority of their assets, maybe 80% or 90% or more, into the S&P Wink with tongue sticking out 500 ETF. That's because these 500 plus companies, the companies included, and the stocks they hold, are the 500 most competitive companies across all industries in the US. So, if you're an investor who wants stability, putting a portion of your investments here is a solid choice. You're basically participating in the growth of the US economy and its industries, without having to worry about how individual companies are managed. Why? Because these companies are managed by top talent from business schools, people who are strong in math, marketing, business development, and have excellent international perspectives and cross-border abilities. They're the ones handling things for you. That's what the S&P Wink with tongue sticking out 500 is all about. The index itself has recently hit new highs, and then pulled back a bit, which is normal market fluctuation. Right now, we're also in a rate-cutting environment, so there's more liquidity and lower capital costs for businesses. Alright, the second point is historical data to back this up. Let's also talk a bit about how historical data supports what we're discussing here. There are basically two main points. Buffett actually once made a 10-year bet with a hedge fund manager. The winner would get about $1 million. If I remember correctly, it was around $100, but anyway, it was definitely over $500,000. So, they made a bet. The fund manager picked 5 carefully selected hedge funds. These are smart people, right? All top Wall Street talent. Probably all Ivy League graduates. So, what's the second one? Buffett's pick is VO. Let's use the code VO here. Actually, there are similar ones, like SPY. VO and most of these are S&P Wink with tongue sticking out 500 ETFs. If you want a lower price point, something more affordable to get started, SPLG is another option. In short, they're all S&P Wink with tongue sticking out 500 ETFs, but you can even find more if you look. All of these are mentioned here. So, what happened after our 10-year bet? Well, according to the data from Gene, one of them had a double-digit return. If I remember correctly, it was about 30-something% to over 40% growth over 10 years. But the S&P Wink with tongue sticking out 500, which the investment legend recommended, had a return of over 130%. This has already been reported by magazines and the media before. This is one of the points. Next, there's also a principle behind how the index is constructed, which we didn't cover earlier. The S&P Wink with tongue sticking out has actually been around for a long time, even before this. Regarding the program data and backtesting, actually, I talked about this internally at the company around January or February this year. Over all these years, let's say over the past 80 years, if we look at it this way, from the beginning of the year to the end of the year, and then from the end of the year to the start of the next, whether it's positive or negative. So, for each year, if it's positive by the end of the year, we add 1 to the positive count. If it's negative, we add 1 to the negative count. With all this data, over about 80 years, the ratio is roughly 3 to 1. That means from the start to the end of the year, the market goes up 3 times for every 1 time it goes down. So, from start to end, if the market goes down, that's 1 negative year. Years with negative performance are 1 out of 4, a 3 to 1 ratio. If you don't worry about timing and buy-in, by January 1st and sell December 31st, if you do this 4 times, you'll make money 3 out of 4 times. And 1 time, you'll lose money, That's just how it is. So if someone really wants to make this a core asset and hopes for some returns, they can consider it. Recently, this small cap stock hit a new high and then pulled back a bit. So of course, when things are high, you need to be cautious. We're just letting everyone know here. So what about the Nasdaq 100? Same thing. Technology, biotech, semiconductors, the most advanced technologies are all in the Nasdaq 100, along with innovative business models. Here, we're not just talking about technology. Whether it's AI, pharmaceuticals, or whatever new developments come out, be it neuroscience, genetics, or anything else, we cover it all. Its business models are also included in there. But it also faces a problem. There are both factors that drive it up and those that bring it down. The positive side is the ongoing interest rate cuts, which lower the cost of capital, and as a result, the general public feels more confident about spending. Right. This is a balanced perspective, just like what Wall Street has considered before. Many managers have also mentioned that its valuation might be too high. However, whether it's really too high depends on whether its profits can keep up. If these business models and technologies can truly generate revenue and deliver higher profits, then there's no problem, because this is something that can change. As each quarterly report is released, this can change. Alright, as we can see, when risk outweighs profit, like Buffett says, the main players can't sell when the stock is locked up. You can't have some people taking on the risk while others reap the profits. That wouldn't be right. So in this case, while controlling risk, we also think about profit. We might have a lot of ideas about making money, but if we only consider risk for a year, what happens if something unexpected occurs? That's something we need to pay attention to. As I mentioned before, the index this year, from January up until now, has actually been quite low. It's been below 14, meaning there haven't been many chances to see it above 14, less than 10 times, actually. Lately, it's been showing up a bit more often, which means that if any negative news comes up next, the market will be more sensitive to it. So, please pay attention to your capital management. Don't go all in every time, okay? Really, don't go all in every time. You don't have to do that, so you can feel more at ease and sleep better at night. Or you won't have to spend all day anxiously watching the market after hours and feeling tense all the time. This is about your emotional well-being, and honestly, doing this really helps. It's also good for your physical health, otherwise your mental state will suffer. Now, let's look at the latest trends in the US stock market and key stocks. Let's discuss them. AppLovin, an advertising tech provider and basic service provider, as well as Robinhood Markets, have both been included in the S&P Wink with tongue sticking out 500 index, which is a big achievement. They've been developing well for quite some time, and recently they've continued to invest, not just in cryptocurrencies, but also in expansion and tokenization, among other things. So, from these results, what signals are investors seeing? Let's analyze that here. This kind of surge, even being included, because it went up a lot. When it goes up a lot, its market cap expands. Since the S&P Wink with tongue sticking out 500 looks at market cap, as was mentioned in the stock management section, there was also a third point related to the index, and a fourth point about the high proportion held by the Magnificent Seven. Everyone knows about that. Now, the principle behind how the index is constructed and which stocks are included actually has certain requirements. For example, it only includes companies that have been profitable in the most recent 4 quarters or in the past year. In other words, if a company hasn't been profitable for a long time, it can't be included in the S&P Wink with tongue sticking out 500. So, what they're trying to tell investors is that today, I'm using corporate profits to let investors become part of this kind of index, which includes not all, but many of the most profitable companies in the United States, either the strongest overall or the leaders in their respective fields. Basically, it's those few companies, those 500, because the selection pool is actually really big. There are even companies from other countries, but of course, we won't get into that. Actually, there are a lot of companies worldwide, but what matters most here, related to how the index is compiled, is this. Recently, they've required that you need to be profitable to be included. If you're losing money year after year, you probably can't make it in. There's no story, so you just can't get in. So if this negative one rises that much, you can see that the recent trading volume actually shows that confidence in the stock market is pretty strong. Or you could say there's another subtle point implied here. The trading volume for virtual currencies or virtual assets also reflects strong confidence. Because this is actually a kind of risk indicator as well. Okay, so this gives you that kind of signal. Now, let's look at the second one, Asian stocks. Along with the US stock market's expectations of rate cuts, they're also hitting new highs, and the same goes for European stocks. So actually, I haven't listed any European stock market trends here. I used to include them, but not anymore. As for the US stock market, I just checked and pre-market is up about 0.05% to 0.35%. For Japan, the catalyst is still there. It's about whether Ashiba will resign or not. If she steps down, then one of the risk factors people are worried about will have decreased. So that means maybe, like Buffett holding those 3 color stocks, he said not to sell, right? Not to sell for 50 years. So maybe everyone will just keep following him. Blue chip stocks are hitting new highs and so on. The Hong Kong stock market is also up today. Let's take a look. For the second topic, let's look at the leading players in this field. Here are a few of them, and their codes are listed here. If you can't see them clearly, you can always replay or rewind to check again. WeRide, Baidu, Pony.ai, Mobileye, which is related to Intel, then Luminar Technologies, LAZ, MBLY, Tony, Pony.ai, Baidu, Veride. Baidu is also listed on the Hong Kong Stock Exchange, and WeRide as well. Actually, WeRide started out as a technology company. There's a lot of information here that you can go back and review if you want. Actually, they've also worked with Uber. Recently, Baidu has done the same. They've partnered with Uber on the international stage. Domestically, for example, they might collaborate with the biggest players like DB Chuxing. In fact, whether it's in major cities, especially places like Shanghai, they're very active. In big cities like Beijing, they've obtained licenses to operate truly driverless taxis. By taxis, I mean regular cabs. Let's call them cabs for simplicity, not traditional taxis. These are autonomous vehicles with preset routes. You tell it where you want to go, it sets the route, then takes you there. How does it work? You pay online, and the transaction is completed directly, no driver needed. That's basically the concept. In reality, Baidu has been developing this for quite a long time. Pony.ai is also similar to WeRide. They're more like technology operators. And since it went public this year, it's more focused on components, like its optical LiDAR. They use LiDAR to measure things like distance, direction, and speed, that sort of thing. Alright, now let's take a look. If you haven't gotten involved before, or if you're thinking about getting involved next, what kind of strategy should we use to find which targets to invest in? Maybe that word from earlier, like a starting point, or an introduction to commercial operations using passenger cars. Yeah, that's a good way to put it. Thanks to the netizens and viewers, just one sentence solves it. You can just call them commercial passenger vehicles, the ones that carry passengers and you have to pay for the ride. If you need to go somewhere, you just pay and have them take you there. First, we can look for those with much data, the market leaders, basically, the ones you've heard of. Let's not discuss the most common ones everyone knows. For example, Google's Waymo, which most have heard of. They're all in the US, mainly in California, and they've already started operating there. Or take Tesla, for example. They've been talking about doing this road for a long time. They're actually partially testing it. So, when it comes to companies with strong financial backing that can get these vehicles on the road, we've mentioned them. Google is strong enough. They have plenty of financial resources. We're looking for targets in this area because it's a new industry and track that has only started to take off in the past 2 or 3 years. If you want to make it to the finish line, you first have to be able to survive. If you crash in the middle of the race instead of overtaking on the curve, then we might have to drop out of the competition, right? We could end up being acquired or even go bankrupt and liquidate. So, if you want to overtake on the curve, first your gas tank needs to have enough fuel. Right now, the ones with the biggest tanks are, for example, Tesla or Google. Their tanks are huge. Their exteriors are the toughest, so they're less likely to get damaged in a crash and can handle rough conditions. They can handle rain or slippery roads. You want to look for these 3 qualities. As for individual stocks, why has Baidu performed so well lately in both Hong Kong and US markets? Both surged past 100. Baidu in Hong Kong broke $100, and in Hong Kong dollars, it also surpassed 100. Their artificial intelligence models are the reason. Baidu has Baidu Brain and Baidu Core. I won't go into too much detail, but it's because Baidu integrates with things like Baidu Maps and, as I mentioned earlier, their international collaborations with companies like Uber. Their autonomous taxi project has everyone feeling optimistic. Plus, they're about to hold a developer conference to see if they'll showcase any new technologies. Alright, in the past few days, its stock chart has been soaring. As you can see, it was consolidating for a while before this. It had been consolidating for a long time. And this year, its stock price has lagged behind others like Tencent and Alibaba, and other tech and internet companies. But now recently it has really taken off, and while you can't quite say it's overtaken others on the curve, it's definitely catching up. To be honest, that's the situation. Since there are many details here, let's focus on the main point. It's dedicated to developing and commercializing autonomous driving technology. And lately, its internationalization process is moving fast. As mentioned, if you have a lot of data or are already a frontrunner, you've obtained driving licenses in major commercial hubs like China, UAE, and Singapore, places where commercialization is highly developed. So, in over 30 countries, they already have R and AMP winking and laughing in operations. Looking at the stock price chart, after the previous drop, it went down from over $10. But it's actually been consolidating for quite a while now. It's been settling for some time, so you can take a look at it. If you want to treat this like those gold or silver mines we just talked about, or apply that kind of logic here, that's not out of the question either. Why? We know that companies like Baidu, Wenwen, and Pony.ai all have this kind of technology, right? This technology is basically their mine, their intellectual mine and their technical patent mine. Their mine is only so big for now, let's say, but in the future, it will gradually get bigger. So of course, you want to buy in at, say, an 80% or 90% discount, right? That way, if it really does go up in the future, it's just like what we're seeing with Baidu. Right now it's at 101. Last Friday it closed there, and today it'll probably hit a new high, setting a new peak, as its Hong Kong shares are up, and tomatoes should be up too. You'd hope that if it's at 101 now, you would have bought in at 95, or maybe you'd wish you bought at 85, or even at 75. The returns would be totally different, right? So, the same logic more or less applies here. It's just that looking at individual US stocks is still a bit different. If you can apply this logic, then go ahead. It really depends on each person's preferences and trading habits, and it's also related to personality. Can you hold on? Can you handle the pressure? For example, when the price is fluctuating, can you withstand the drop? This really depends on each person's skill, you know. If you get scared after just 2 or 3 days of a drop, then maybe you need to work on yourself a bit more, or find some other methods to help keep your mind steady. Or you could try entering at an even lower point from the start. Find a price where you truly feel that even if it drops to that level, you still won't be afraid. If you've already done your research, or have confidence in its finances and future development, then there's no problem. For example, many Tesla or Nvidia fans are like this. They know the company is good, so when the price drops, they buy more, and when it drops again, they buy again. Over the long term, they profit from these cycles. Right. Okay, so it's the same with the Xiaomi stock. In terms of strategy, actually, if you want to buy it at a relatively low point, there's another approach you can take. Let me share another method here. You look for this kind of situation. When it drops, especially when it drops deeply and the deviation is large, you buy gradually. For example, in the previous wave, we saw that the stock price was here, and its short-term and mid-term moving averages were here, right? The 20-day and 50-day averages were very far apart here. You just draw a straight line. The farther apart they are, the better. Treat this line as a straight line. The farther the distance, the better. The farther apart they are, the more confidently you can buy. For example, if it drops like this and the distance widens a bit, you'll feel more confident buying. If you buy here, of course, it's a bit, how should I put it? You'll probably have to wait a bit longer. If it only rebounds to the 20-day average, then you'll break even. This is the investment method we just mentioned. The lower your buying price, the more advantageous it is for you. This is also related to some value investors, like Buffett or Howard Marks. They all hope for this kind of situation. When you're evaluating the relationship between value and price, you need to weigh them. Value is what you get. It's the value of the company, since you're buying equity. But what price do you have to pay? Of course, you don't want to pay too much, right? Okay, now let's take a look at the international situation. Because of time constraints, I won't talk for too long. So we see that the European Union is imposing new sanctions on 6 Russian energy and banking companies. This is already the 19th round of sanctions. Let me ask a question here. Is Putin scared? Alright, so this Russian Tsar, let's call him the modern Tsar, or the current ruler, is he actually scared? No, right? Honestly, he's done it before and never been afraid. In 2022, he launched this war and invaded Ukraine. He said he attacked because he was afraid of NATO's eastward expansion, and up to now, no matter how many rounds it's been, and no matter what kind of sanctions the US has imposed on him, it hasn't mattered. He's not afraid at all. Whether it's about his rivals or, like before, when Prigozhin tried to march on the capital, he wasn't scared either, right? And in the end, Prigozhin died in that plane crash. Well, that's just how it is. So next, we have to look at what's really going on. The Russia-Ukraine war won't end soon. Why? Core interests and conflict points haven't been resolved. Ukraine refuses defeat, unwilling to cede land. Russia, holding ground, seeks more territory, that's all. That's how Russians are, they're like that. So if you're talking about a ceasefire, it's not going to happen soon. Unless there are new developments. Putin has China and India on his side, about 10%. You could call them the new generation of evil Axis countries in this new century. Or you could say, the new generation of countries that are relatively less democratic and free, more inclined toward authoritarianism, or have ambitions to expand their territory. Or maybe you see them as countries that are militarily strong and place a lot of emphasis on military technology. Countries with strong military power. To avoid loaded language, we can describe it that way. What important financial and economic events are coming up? Tomorrow, September 9th, non-farm payrolls will be announced. As mentioned, there's the annual benchmark revision for non-farm payrolls, and they will also revise the entire year's data. At 1 a.m. on the 10th, Apple's launch event. Then PPI and CPI, and their price relationship. We mentioned the Fed's first major mission, the second employment. Then the University of Michigan Consumer Sentiment Index. This ties back to what we talked about, whether rate cuts stimulate consumer confidence. Alright, let's take a look at the dates for US stock earnings reports. For this week, SMPS is reporting after the market closes, and Oracle, ORCL, is also after hours. This is related to retail, like Lala, and then there's IDEXI and Adobe, both reporting after the close on the 11th. Each of these is connected to that. Sales of department stores, daily necessities, these are all related. It's connected to supermarkets that Americans commonly use. Now, let's take a look at the pre-market gainers and losers. Actually, today there are a few big stocks performing pretty well. Oracle and Tesla, for example. Broadcom.com, and then the gold mining company Newmont we just mentioned, right? Corning, this semiconductor, Occidental Petroleum, these are all doing pretty well. Intel, and also Silvergate, the securities are also performing well. As for the cruise lines, things aren't looking as good over there. A small drop of about 3%, but overall it's still okay. The rest is pretty much the same. So actually, today's talk has gone on a bit longer than usual, a little longer than before. Thank you all for watching, and I'm glad we could have this group session tonight. We'll wrap it up here. I wish everyone good luck with the US market opening soon, and also with the Taiwan stock market tomorrow. Hope everything goes smoothly for you and you make lots of profits. I'm Guo Yuan from Kuning. Good night, and see you all tomorrow. Alright, bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.